The Bank of Canada did it again. They raised their policy rate by another 75 basis points. Both economists and bankers were expecting it, and consumers were bracing for it. So let's look at what this might mean for the average person. Well, back in July, the bank told us that this would be coming, and most economists expected the rate increase to rise by about 1% more before the end of the year. Now it appears that 1% estimate was just a little bit low, and we're going to see a bit more increase before the year's over. The bank cited the now 6-month long war in Ukraine, ongoing COVID 19 lockdowns in China, and volatile commodity prices as the main drivers of elevated global inflation. But of course, elevated consumer demand can't be ignored either, and really, that is what the interest rate hike will be able to address. Looking at this graph, we can see that inflation in Canada, that's the top line, dropped over the summer months. This was due largely to the reduction in gasoline prices that we've all enjoyed. Now, when we ignore that, inflation is still a concern, and we all know that everything is costing more now, and it's not just lumber and building supplies, but it's groceries, and services are starting to get more expensive as well. Central banks worry about extended periods of inflation because when people and businesses expect inflation to remain high, it can lead to a self-fulfilling prophecy. Businesses set future prices higher, while workers negotiate future wage increases to match up with their expectations of inflation. So, how will this impact your mortgage? Well, this rate change of 75 points equates to approximately $41 of increased monthly payment for every $100,000 that you owe, assuming a 25-year amortization. Should you lock in now? Well, that's a complicated question, really with no clear answer. And really, I'm in the same boat as any of you in a variable rate mortgage. I have a variable rate mortgage at 4.55%, and I do think that it will go above the level that I could lock in today by the end of the year. But what I'll tell you is that I'm not going to lock in, at least not yet. Let me show you a little bit about my math. I ran a scenario here where the option for a 5-year fixed is 4.59%. And then I also showed a 75-point increase to the rate before the end of the year, followed by a 0.25% rate drop starting in January of 2024, and then every 6 months for the rest of the term. And that is approximately the break-even point, with only about a $307 savings on the variable rate when compared to a fixed. Now, a variation on that. If we add 2 more rate drops in 2024, thus front-loading the rate drops the same way that the increases have been front-loaded, now the savings are over $1,800 for every $100,000 borrowed over the next 5 years. Now, what this doesn't show you is what could happen if you hang tight with your variable rate, and then later, if or when the fixed rates are lower, you lock in. I know some of you want that peace of mind that a fixed rate provides, but without the regret of locking in when rates are at their highest point. So you know what? If a fixed rate comes along in a year or so and it's closer to 3 or maybe 3.5%, that might be a moment that you would regret having locked in at today's rate. And if you're in a variable rate, you could look at or consider changing over to that at that point. I still believe that there's a great case for taking a variable rate mortgage today, or for keeping the variable rate that you might already have and then monitoring it for a fixed rate if a good rate opportunity does come up in the future. CIBC's Avery Schenfeld is CIBC Capital Economists' chief economist. And he agrees that additional rate hikes beyond October are a possibility, but he also says that there should be some consideration for the time that it takes for these rate hikes to start impacting inflation and the economy. He says a front-end loaded strategy for rate hikes is designed to take rates up quickly, but also it behooves the central bank to pause at some point to see how the economy is coping, given that there's a lag in seeing that response in growth and an even longer lag to see its impacts on inflation. Really, of course, what the bank needs to do is make sure they stop these rate increases before it negatively hurts and puts us into recession. Thankfully, there are signs of changing consumer behavior. I've read of recent surveys in Alberta suggesting a change in consumer spending, but it just hasn't been enough yet. The bank's governing council still judges that the policy interest rate will need to rise a bit further, and how much further is, of course, the million-dollar question. But like I said before, the consensus seems to be that rates will increase either half or three-quarters of a percent more before the end of the year, where they should then stay for about a year before starting to come back down toward neutral territory, which is a percent or two lower than where we're at right now. So, what about the housing market? Well, with higher mortgage rates, the housing market is pulling back as anticipated following unsustainable growth nationally last year. Now, in Calgary, the local real estate market has come off of record activity levels that we saw in the spring, but that activity level didn't even compare to what we saw in Toronto and Vancouver, which is where we've seen most of the drops. So, as far as price drops in the Calgary market, we've only really started to see that in that higher end of the market as buyers are showing more restraint, but these buyers are still buying, which is keeping some elevated competition in the more affordable price points. That said, the market in Calgary is starting to become more balanced, which benefits buyers. Buyers are able to see a property more than once before making an offer and are able to include finance and home inspection conditions in those offers. That's something that we weren't really able to see much earlier in the year. Now, for Edmonton, it didn't get as difficult for buyers, but the trend toward balance is still similar to what we're seeing in Calgary, even better, perhaps. So, to wrap it up, as always, I'm going to end with an invitation here for you to reach out to me or to my team if you have any questions or concerns about your mortgage or about where things or about kind of getting there and snatching up a home while there are still some good deals to be had. Look forward to hearing from you. Thank you.